Hello, welcome to another video from stageanalysis.net. Today's video is my regular update of the major US stock market indexes and the key market breadth indicators, including the Bullish percent index, the percentage of stocks above their short, medium and long-term moving averages, the advanced decline line indicators, the new high, new lows indicators, and some custom indicators exclusive to stageanalysis.net, including the sector breadth chart with the relative performance rankings of all the major sectors. This week's In Focus segment at the end of the video is a follow-up on the gold and silver mining sector that I highlighted in my previous video at the start of May, as it's had a very strong week with multiple breakouts in individual stocks, as well as the major ETFs that track the sector. The purpose of this regular market breadth update is to help determine where stocks will go next based on the combined signals of all the market breadth indicators, which is referred to in the stage analysis method as the weight of evidence. To see more of the market breadth charts and regular stocks watch lists, go to stageanalysis.net. And to get all of my latest videos, subscribe to the YouTube channel and hit the like button please, as that helps us get found. Let's begin this week by looking at, as we always do, looking at the major market indexes. So first up we've got the S&P 500, which this week closed down 2.26%. We are above a declining 10-week moving average still, and still below the declining 30-week moving average. The recovery has been very strong since the March low, but we're still struggling around some key levels up here. The Nasdaq, which you can see on the right over here, has remained above its rising 30-week moving average for the last, 4 weeks now? 5 weeks above, and now the 10-week has turned up as well. It's had a very strong recovery back above, and basically, I've seen some people saying that this is back in stage 2 now, but that's wrong. In stage analysis, when we have a stage 4 decline, you don't immediately reverse back into stage 2 until you've actually made a new high, or at least we get a swing high and then another breakout from there. So basically, when you have a short, sharp stage 4 decline and it breaks back up again into what would have been the stage 3 range, the base is reset and this becomes stage 1 now. So we're still in stage 4 in the S&P 500, and we're in stage 1 in the Nasdaq. In the NYSE composite, which is obviously around half of the market, we've done a lot worse than obviously the Nasdaq there. As you can see from the relative strength versus the S&P 500, this has continued to decline and got even worse since the pullback began from the March low. So this is looking very weak, and attempted this week to push back below the declining 10-week moving average, although we did have a little pullback at the end of the week, but it is looking very weak and still below a lot of resistance. It didn't even manage to get up to those resistance levels, and still chugging around the 2018 levels here and near the lows. Small caps even worse, down 7.59% for the week, and it's closed right near its declining 10-week moving average here. Relative performance is right down by the lows, so potential for a relative new low there as well, while the index has obviously been pulling back. So yeah, weakness in the small caps, which in order for a sustainable rally, we need to see those rallying strongly. So we need to see that turn around. So let's move on. Okay, next up we've got the 7 to 10 year Treasury bond ETF on the left up here. So the price action has been tightening for the last 5 or 6 weeks now. We've been in a very, very tight range. Volume has remained very low, around sort of its normal average volume, and we're obviously pushing up in this little triangle pattern here, so there was potential for a stage 2 continuation breakout in the Treasuries again here. Gold, which is the continuous contract, I noted earlier in the week, if any of you follow me on my Twitter handle, which is @stageanalysis, we were forming a 4-week triangle pattern, and basically it was getting very tight in the triangle there, and we broke out significantly on Thursday, which obviously sent the gold and silver miners popping as well, which I'll highlight later in the video. Back down to, so with gold we've got potential for a stage 2 continuation breakout to new highs. We'd want to see some strong volume coming in on the move to new highs as well, but it obviously hasn't broken out yet, so the volume is not concerning until we actually get the breakout. WTIC, which is the crude oil chart, West Texas crude, and has continued to rebound from its extreme negative rates that it got down to a few weeks back. Obviously to be expected after such an extreme move, but remains in stage 4 decline, basically on its first significant pullback. What we got next? Copper. Copper had another down week of 3.14% there. It remains below the stage 4 breakdown level and is turning back down here. A break below this two-week range here that we got, the two lows there, would send it back down into another pullback and decline to the lows. So this is still acting quite weak and remains in the stage 4 decline. Okay, next up we've got the percentage of stocks above the 150-day moving average. This is done by sector, and we're starting off with the table view first, so you can see what's been going on. Healthcare and technology remain the two strongest sectors, with healthcare the strongest currently, with just over half of the stocks in the healthcare sector above the 150-day moving averages. It had the strongest move of the week at 1.49%, which is pretty pathetic, but it shows how bad the week was in terms of stocks declining below their moving average, because every other sector got hit hard. But because healthcare and tech have been leading recently, this has been propping up the market, so we didn't see quite the sell-off that you would have seen otherwise if that had been weak as well. But tech, obviously the other sector that's been propping up the market, did have a big drop of 9%. We're back down to 39% of stocks above the 150-day moving average in the tech sector, which obviously shows some weakness creeping back in after it's been strengthening so much. And so if these two sectors start to pull back strongly, then we've got to see rotation from other sectors in order to replace them. So basic materials had an up week of 0.66. This will be based on the moves in the gold and silver miners primarily, but like I said, it's not a very big sector, so gold and silver stocks moving to new highs will not prop up the market. You need to see financials, industrials, or consumer discretionary moving up to replace this, because they are the three other big sectors on this list. So and these all remain. We've got consumer discretionary at 18, financials at 8, and industrials down at 8. So these are anemic at best and had another down week. So obviously this is not looking good. Let's look at so this is the visual view of what I've just been talking about there. So as you can see, healthcare way out in the lead, at the 50% range, so which puts it in stage 1 or stage 3. We've got all other sectors below the key 40% level here, so which is obviously bearish range. Anything below 40% is in the bearish range still. So although tech has been strong, it's pulled back below again this week. So we did have a pop up back into neutral minus territory there. So potentially showing signs of stage 1 maybe, but it's pulled back again. So we would need to see this push back up again, and especially above the 50% level. But yeah, the majority of sectors here, as we can see in NYSE, remain in the very lower levels. We've got financials, industrials, energy, real estate, consumer discretionary. These are all primarily stocks that you find in the NYSE, whereas tech, healthcare, communication services are generally more Nasdaq. So that's why the Nasdaq is above the 30% level, but obviously it's still below there. So what was our average again? So the average for the week was 23.33%. So we're still in the lower levels, and we need to see that popping above the 30% level in order to start getting a bit more interested again. But at the moment, that figure has remained in the 20s. So next up, we've got the bullish percent index. So on the left, we have the NYSE bullish percent. On the right, we have the Nasdaq bullish percent. And down below, we've got the percentage of stocks above their 200-day moving average, the 150-day moving average, and the 50-day moving average. So this how this works is that you look at all three at once of these moving average percentages, and so a signal in one of them, it doesn't have strength. Basically we need to see a signal in all three in order for us to change our tactics. So although the short-term percentage of stocks above their 50-day moving average had moved up strongly and got above the 70% level for a little bit, and same in the Nasdaq, we've not seen the same in the 150-day and the 200-day. Like we've seen a pop up in the Nasdaq stocks a little bit, but even they didn't get very far, and the 150-day and the 200-day only made it up to 35% levels and finished the week at 33 and 34 there. So basically the signals come from point and figure charts, but you can see them, you can often see them on the line charts as well, as it will simply be a breakout from a double, like a double top type breakout. So you'll see a pop up and a pullback and then the break above the line. So but you don't always get that. Sometimes you get straight whipsaw moves, but generally you want to see what we're seeing down here in this one previously in 2018, where you've had a pop up and pull back, and then the signals come with the break above there, and at the same time you want to see signals in the longer and medium term ones as well, so they're also breaking above levels of resistance and moving back out and getting back above like the key 30% level and recent resistance. So you want to see a signal in all three at the same time, not just one moving up while the others remain anemic down in the bottom zone. So we want to see all three of these popping up out here above these levels here on all three charts. This week we also saw in the bullish percent index here at the top, you can see we had a pullback here and push up and pull down. So on the point and figure charts, which I'm not showing today, we actually moved to a bear confirmed status again with this breakdown here. This was a double bottom breakdown on the PNF chart and a double bottom breakdown on the PNF chart here. So actually I don't think the Nasdaq one was. I think the Nasdaq one, although it shows on the line chart, this low here wasn't big enough it didn't have the 6% range that we look for in order to make a new column. So this one is still on bull correction, whereas this one is on bear confirmed. Next we've got the advanced decline line charts. So in this one, so on the top left here, we've got the cumulative advanced decline line. We moved above the declining 50-day moving average a little while ago, and obviously signaling a little bit more strength. It started to move to a short-term bullish signal, but that bullish signal is under threat now as it's pulled back. It's made a slightly lower low here, and it's still above a declining 50-day moving average there, and this line here, this breakdown level here, so a break below both of these would move it back to a bearish signal. So it's kind of on a neutral signal currently. The McClellan oscillator at the top here broke down this week, and the pullback on Friday didn't make it back above the zero line there. So as you can see, we've had sort of head and shoulders type pattern on that, and it's pulled back below the zero line there, so moves to a short-term bearish signal. The summation index crossed over its signal line. It hasn't gone down past the zero line yet, but also the crossover this 10-day moving average there, it moves it to a short-term bear signal as well. The 10-day moving average momentum index. So the momentum index is what's talked about in Stan Weinstein's book, which is calculated by using the 200-day moving average and of the advanced decline line. And so this is the one we show at the bottom. The middle one here is the 10-day moving average. So it's used more as an oscillator and is very similar to the McClellan oscillator. Works in the same way. So as you can see, we had a break below the zero line and recent lows here, and the pullback didn't make it quite back up. So this also moves to a short-term bearish signal. The actual momentum index is close to its lows again. It's still below. It's still obviously declining down, so remains on a bearish signal. The cumulative 10 and 30-day EMA lines here, so this has been on a positive signal since late April there. We had a few crossovers and back, so it's getting close together again though, so there's potential for a cross below again, but at the moment it remains on a bullish signal, although obviously it's on a warning signal there. Next up, we've got the new high, new lows. We moved the 5-day new high, new lows has moved back below the zero line, minus 35 here this week. It's been, the new highs have been anemic throughout the rally. We haven't got very far at all, and so to move back below the zero line, it's a little concerning there. The cumulative line at the top here, as you can see, has started to pull back down, remains below a steeply declining moving average. Down the bottom here, we've got the individual, the new highs is the grey area and the new lows is the red area. So the signal line is crosses above 100. So we haven't had 100 new highs since the February breakdown in the NYSE. We did this week see a pop above on the Nasdaq with a couple of days of 100. So we had a little signal, but it was immediately reversed with new lows coming in there, and new lows on the NYSE. So these remain on neutral, and short term we're still on neutral to bearish signals on the new high, new lows. Right. Next up, we've got this week's In Focus piece, which is on the gold miners. So as we showed earlier in the video, gold broke out of a consolidation pattern. It hasn't made new highs yet, but it broke out of its consolidation within its range, which popped up all of the gold miners and the silver miners alike. They all got a bid from it, and we saw lots of new highs in the sectors. So these are the major ETFs in the gold and silver sector. So we've got the GDX and GDXJ, which is the juniors, and we've got the SIL and the SILJ, which again, the SILJ is the juniors. As you can see, silver has been underperforming gold, and obviously the juniors remain below like the January highs up here, whereas the larger cap silver miners, we're starting this week with the pop, saw the average price move above the January resistance, so we've got some new highs coming in there. The gold junior is the same as the junior silver miners. We're still below obviously with the February high there. It has moved up strongly. We've had 100% moves in most of these off of the lows, but the gold miners ETF broke out a while back and has been consolidating and broke out again further this week. So let's move on to some of the individual names. So some of the individual stocks, NEM, I actually took a position in this one on Thursday, and gold, which I took a position in late on Thursday as well. So I had a good start with both of these, both up 3 or 4% from my entry point. NEM has had an extremely good move since the March low. It's obviously recovered well above 100% of its move down, and gold, Barrick Gold up here, is just approaching the pivot point on the pivot line. I got in early because I was playing the NEM breakout, and so I got in on this bar here on the similar move where it had moved 5%, and the volume we had some stronger volume coming in on the day, so I took that one too. FMV, and another one of the strongest gold miners. It's been having as you can see, a stair-stepping pattern up since the initial breakout point back here. It's showing some good movement there. And AU is another one hitting the pivot point. It's just breached the pivot point on Friday at the close. It had one of the strongest moves of the day, up 6.53%. See the relative performance versus the S&P 500 hit a new high. We got new highs. Gold hasn't yet hit a new high there, but it still hasn't broken out, so it looks in line to make a new high when it breaks out. And FMV has also made a new high. Okay, moving on, we've got this is some of the silver miners that are highlighted in the watch list this week. We've got PAAS, which broke out on Friday with a good strong 2 times the average volume spike there. It broke above the pivot and the downtrend line there. It still hasn't cleared the February high here, but obviously broke out and moved very strong 11.52% there. RS has popped to new highs. Another one this week was SSRM. I believe I highlighted it in the watch list down here on the reversal here just before earnings. It obviously popped on its earnings, and we've got some strong relative volume coming in, and the RS has been screaming to new highs. So that one's looking very, very strong. MAG is another one. It's a smaller name. It's had a very strong volume pop there. It's been testing, this level's been tested around 3 or 4 times, so you've got a strong move there. So a break above this and close above here would be a very good sign, as the RS is also at new highs and we've got strong volume. FSM is another one been watching. RS again at new highs. It's broken out from a cup and handle type pattern down here. Again, it's below, like a lot of the silver miners, it remains below the early January range, so not as strong as the gold miners, although they've had similar percentage moves, but there is more resistance in the silver miners, and they have much greater correlation with the stock market moves. So if the stock market did move back strongly, then the silver miners tend to have a lot more volatility. So that's one thing to be aware of when trading the silver miners. Other silver miners on the list was HL. I can't remember the others off the top of my head, but there's quite a few. So yep, definitely this is what we call in Stan Weinstein's method the forest of the trees approach. When you get a strong sector move, it's time to look at that sector, especially when it's a strong sector move that's where you've got multiple stocks breaking out at the same time and you get heavy volume coming in. Volume is key. If you do not get heavy volume coming in, although they're all breaking out at the same time, it is a warning signal. So it's good to see the silver miners getting some volume. The gold miners, the volume's a little bit more average, so I'm kind of attributing it to the fact that gold hasn't yet broken out fully. So if gold makes the breakout, I'm sure the volume will come in, but obviously until it does, at the moment it's a little bit of a warning signal to be aware of. Okay, so let's end the video this week with the 4 stages once more, just so that people can be aware of these. I've had different discussions with people about it over time, and obviously with more and more CanSlim people watching the videos and talking to me, there's obviously a bit of a conflict at times, as CanSlim stages in CanSlim can be like the base count stages. So although you've had they count like a breakout, that this down here is a stage 1 base, and then this is a stage 2 base, and this is a stage 3 base, and then the next base up here is a stage 4 base. So instead of actually, like in Stan Weinstein's method, it's obviously only got 4 stages, and the bases, it's easier if we refer to the bases as bases and not stages, because otherwise it gets very confusing. So obviously the stage 1 the breakout from the stage 1 range here, that's a stage 2 breakout, because you're breaking out into stage 2. You've obviously got your initial base here, so that would be base 1. You've got another base here, so that would be base 2, and then you've got another base here, so that would be base 3. So breakouts above the 3rd base, like in CanSlim, like they talk about, is obviously third base breakouts and above tend to fail more. So yeah, obviously this one had a good strong final thrust before you got some strong selling coming in, so this one actually failed on the 4th base up here. So, but I think this was NM back in 2013, and then we moved into stage 3 range, and we had a stage 4 breakdown, and it continued to stage 4 decline for a long time. So yeah, I just wanted to highlight that and obviously give you an idea of what the stage analysis is all about. So if you want to learn more about the method, go to stageanalysis.net. It's a website I've been running for the last 7 or 8 years, so there's loads of information on there about the method. And obviously if you want to learn more about Stan Weinstein's method, or if you just want to ask questions, go to the beginners questions thread. And yeah, I post regular watch list stocks that I'm watching that are in obviously either stage 2 or stage 1 bases, and might be close to breakout points, or might have already broken out, and might be ones to watch for pullbacks in the future or consolidations. So yeah, hope to see you there. Otherwise, yeah, like and subscribe to the videos, and I hope to see you on the next one. Cheers.